Okay, we might get going. Hello everyone, and welcome to the Koda Capital virtual Meet the Manager event. My name is Jonathan Ayres. I'm the managing partner of Koda Capital in the lockdown state of Victoria, and I'm joined by two of our panelists, two of our managers, who I will properly introduce in a moment. There are many Koda clients on the webinar today, so hello and welcome. There are also a couple of you who are not yet Koda clients, so I just wanted to do a quick revisit of what we do at Koda. At Koda, we work with sophisticated individuals and family investors with the aim to deliver them financial peace of mind. We also work significantly with not-for-profits and endowments to assist them in making the best use of their capital. We do that by investing in and possessing skill and experience and capability in financial strategy, in structuring and investment and portfolio strategy, in philanthropy and social capital, and in what we call family leadership. So to the agenda today, to orient ourselves, we're just going to briefly relive 2020 to date, not too heavily. It's been jarring for a lot of us. We're then going to sort of dive into why private debt and the role that private debt plays inside Koda portfolios. I'll then introduce our managers, and we'll deep dive into their firms, their investment strategy, how they see this investable opportunity, and clearly COVID-19 and how that is impacting and benefiting and presenting opportunities for these types of strategies will be a huge feature of that. We won't probably cover all of it in that order, but hopefully at the end of this webinar, we can cover all of that ground. Just some logistics. We've got quite a number of you, over 150 of you on the webinar at this point in time. So to preserve the viewing and listening experience, it won't be possible for you to ask questions verbally of our managers. There is a Q&A function on Zoom. If you can tap out a question as we go, it'll come to me and I'll make sure that we cover that either throughout our Q&A session or we've allocated some time at the end of the webinar for Q&A. So let's get started. 2020 at a glance. This is a piece that Bridget Leckie produced in a recent Investment Insight. We probably do need to be reminded that all this sort of started with a localised outbreak in China in late January. Throughout February, it spread really rapidly through South Korea and to Europe, centred around Italy and a bunch of cruise ships. Global investment markets took notice pretty quickly, sold off sharply, and there was a liquidity squeeze on. Throughout March, we'd reached full-scale global pandemic scale. And thankfully, this time around, central banks and governments moved swiftly with vast amounts of stimulus. And I'm sure Mitch and Adrian will cover a little bit of how that's benefiting and impacting their strategies. As a consequence, risk markets rebounded, yield spreads started to stabilise. Throughout May and June, lockdowns were being eased around the globe, and a bit of that pent-up demand was finding its way back into the system. Valuations on equities stretched towards their former record highs. US Treasuries and gold rallied. But now we're facing down the spectre of second waves, re-lockdowns, and the sort of longer term and medium term impacts on markets and most importantly, in economies. And for those of you joining us from the former great state of Victoria, we're in the middle of one of the harshest versions of those second lockdowns. What we do know is that we don't really know what will happen from here. Will it be a second wave, a third wave? Will we see a breakthrough in a vaccine? And can the global recovery kind of get on with itself? We don't really know for certain. What we do know is that a truly well-diversified portfolio is the best way to stack the odds in our favour and in your favour. One of the most attractive components of a truly diversified portfolio that we've incorporated in Koda portfolios has been in private debt. In private debt, we see an opportunity to potentially earn equity-like returns for senior debt type risk. And it's that unique risk-return trade-off, in our opinion, that's been a wonderful diversifier inside our portfolios. We're attracted to the characteristics of private debt before the COVID-19 crisis. And as the crisis unfolds, we continue to be attracted to its inclusion in portfolios today. Compared to consensus, and this on your screen is just a view from our quarterly investment insight and outlook published this week. We reiterate our overweight position in portfolios compared to many of our peers. So why do we like private debt? to pick out a few reasons, and Mitch and Adrian will go into far more detail about this, but we believe that the non-bank lending thematic, led by regulatory change and ending the oligopolies of the Australian Big Four banks, is a structural force and it's permanent. When focused primarily on the senior and secured parts of the capital structure, we believe that stable and frequent returns can be achieved whilst maintaining really strong capital preservation. And Mitch and Adrian will both talk to some of those examples. So let's meet our managers. I'll start with Adrian Redlich. Adrian's the founder, CEO and chairman of the investment committee for Merricks Capital, which he established in 2007. Prior to this, Adrian held senior positions with global hedge fund behemoth, I think I can use that term, Adrian, Citadel Investment Group in both in Chicago, and he ran some of Citadel's largest global equity and derivative investment teams. Between 2000 and 2005, Adrian was a director at Merrill Lynch in both New York and Hong Kong, and further back than that, he worked as a commodity and mining analyst for Merrill Lynch in Melbourne between 1993 and 2000. Welcome, Adrian.
Thanks, Jonathan.
Then to Mitch. Mitch is Managing Director Credit at Longreach Investors. A 16-year long career led him to reach the lofty heights of Divisional Director status at Macquarie, where he was responsible for building a portfolio of senior secured loans. It's that approach that he's been refining and implementing at Longreach. Throughout his time at Macquarie, he held a number of senior business banking and credit positions both across Australia and the US. Welcome, Mitch.
Thanks, Jonathan.
I might just pause my share there for a little bit and start with you, Adrian, if I can. Welcome. And can you just tell us a little bit about Merricks Capital? Can you tell us a little bit about the private debt strategy and how that came about for you and how you've seen the opportunity?
Yeah, sure, Jonathan. And maybe refer you to page 3 of our slides. So
I'll get there.
We will jump a little bit between some of Mitch's slides and my own and some of Jonathan's. And we'll do our best to make it seamless, obviously through the Zoom experience. Merricks Capital is a Melbourne-based business. We do have some staff in Sydney as well. Our focus is on hard assets. We focus on commercial real estate, agriculture, infrastructure, energy assets. And that, as Jonathan alluded to at the beginning, I guess for me personally, is where I started way back some 26 years ago, or 27 years ago now with Merrill Lynch in that hard asset space. And some of my partners, it's really been our journey. What we do that is a little different for a $2 billion fund manager compared to most you'd be familiar with in Australia is over time, so strategically, not sort of on an annual basis, but over sort of with a 5-year lens, we tend to focus on what we think is the best part of the capital stack or the best way to invest in our industry specialty. And to echo some of Jonathan's sentiments, our view is very firmly focused on that senior secured piece of the capital structure. So effectively that means we are the bank, or what the bank would have previously done before the world has evolved and changed in Australia over the last 5 years. So the portfolio that Koda clients are invested in, our partners fund, is a little less than $500 million, and that represents around a third of our credit strategy. The other vehicles are just institutional vehicles, and they are identical in terms of they invest alongside each other. And so for us, really, it is about an opportunity set where we've been able to generate 10% plus returns from senior secured loans. And so in essence, what we're doing is we're the bank in terms of taking a mortgage over commercial real estate, agriculture, infrastructure, the same way that your bank in some part of your life would have taken a mortgage over your house. So it's simple in principle, and the investment thesis is fairly simple. We have a big dislocation in the banking system in Australia that really emerged in 2015. Banking sector had 95% market share in this country. By comparison, in the US, the banking sector probably has 50% market share, and non-bank credit plays its part in the other role. And what differentiates us and non-bank credit, and it's the same for both Mitch's fund and my own, is what differentiates us from a bank is we're predominantly lending, and in this case always lending, equity. So we lend equity to people. We're not leveraged. The 4 major banks in Australia are leveraged 14 times. And I guess it dawned on APRA and the other regulators that at some point the economy was getting a little stretched. And for organisations that hold all of our deposits and all of the supposed boring assets of most of Australia, they should be lending in a boring and conservative manner. And whereas we're able to lend when we're lending unlevered capital, we can take a view which just says, is the asset worth materially more than we're lending? Whereas the bank is much more focused on interest cover, cash flow, and meeting a whole range of regulatory requirements. But I might stop there, Jonathan.
Thanks, Adrian. Mitch, can we sort of pan to you? Can you tell us a little bit about Longreach, why this strategy and why you decided to start it?
Yeah, certainly. Thank you. Longreach Credit Investors was formed in early 2018. Koda being the very early and dominant investor in the Longreach Direct Lending Fund. We, as a business today, there's 6 credit analysts, 1 full-time origination person, and we're lucky enough to benefit from a whole lot of support staff from our parent company, being Longreach Alternatives. So we're the investment manager for 2 funds with exactly the same mandate, and that's we don't do what Merricks excels at. We don't lend against property. And talking about what we don't do, perhaps brings up the value that we bring to Australian borrowers. So our client base is Australian businesses, and importantly, we really focus on a really awkward size of loan, and that's our preferred space is between $2 and $10 million loans, and again, not lending against property. So we're doing old-fashioned business lending, and that we decided to target that particular part of the market because of an observation similar to what Adrian mentions, that Australia was really unusual by international standards and how slow our credit market has been to evolve. I was lucky enough to work on Macquarie's distressed credit trading desk in the US between 2009 and 2011. Clearly a very hectic time in distressed credit markets. But even then, I was able to observe the fairly smooth flow of credit from non-bank lenders to credit-worthy US sort of mid-market, lower-end mid-market borrowers. When I returned to Australia, I saw that wasn't really occurring. Made the assumption that our banks were doing a great job at that, and then was pretty quickly disavowed of that opinion. And how we see the market and why we think that this is such an opportunity is we're writing very old-fashioned, unadventurous loans. We're the senior lender, to borrow Adrian's language, we're the loans that you think banks write. A company that makes $2 million profit a year wants to borrow $4 million so it can make an acquisition. That's our loan, that's our bread and butter. And a lot of folks are shocked to learn that loan is difficult to come by in the Australian market. It's difficult to come by because as the banks have become bigger and bigger and bigger and bigger and bigger, they've forced all of their offerings into products that you can teach people to sell quickly and cheaply. If you want a credit card, that's fine. If you want to borrow against property for your business loan, that's fine. If you want equipment finance, that's fine. But if you want someone with credit training to sit down, understand your business, spend the 6 weeks that's involved to write a credit paper, and really think about the risks and opportunities your business takes and how to properly take security over that business, very difficult to find that credit in the Aussie market in our space. If you want to borrow $50 million or $100 million, fine, much easier. So we specifically target senior loans, that $2 to $10 million space. We do look at some larger opportunities if we have a relationship angle, some larger lends, but that's our bread and butter. And our strong opinion is that the returns that we can generate exceed the risk that we're taking on, just order of magnitude. we're getting just under 12% per annum on the invested portfolio. And to be clear, that's not mezzanine unsecured lending. It's always been the first ranking lender.
Thanks, Mitch. Adrian, just to you, you talked a little bit about the size of this market, this investable market, and how it has differed to other more established markets around the world. Will the banks return? Is the level of regulation so heavy that that retreat is temporary or permanent? What's your view?
I think, Jonathan, I think we are returning to what was normal. If you look, if we trace back to 1990, we had a situation where the major banks were some 50, 60, 65% of market segments, depending which segment you looked at. You did have a whole wave of building societies, alternate credit. We know that was, in some cases they were poorly run, poorly regulated, and they began acting like banks, in the sense they were highly leveraged themselves without the oversight, and it caused a lot of issues. And so that led to really a very strong regulator in APRA and the RBA, so the Reserve Bank. And so we went through a period of the 90s, the 2000s, and it served Australia well. And it's often the case, on the back of a crisis, the regulator gets given some good tools and some sharp teeth, and they held the banking sector in good stead. And combined with Australia being fairly lucky, we missed the dot-com bubble, so we didn't sort of suffer. Whilst we didn't have the euphoria leading into 2000, we didn't have the pain post. And then post the financial crisis, again, we were fairly fortunate that we didn't have the type of products and structures that caused the issues internationally. And obviously we had the fortune of being riding on China's coattails. And so we went a fairly extended period where the system worked. It had sort of destroyed the non-bank sector, and the non-bank sector needed changing if you look back to the 1990s. But I think what's happening now is we're very early on in the cycle, and what's coming out of it is a very sort of secure non-bank lending sector, because effectively we're lending equity. It's not supercharged leveraged vehicles. We have no debt in our vehicles. I believe Mitch has no debt in his vehicles, meaning we don't borrow ourselves. We obviously lend to others. And I think that's critical. So when you look at the size of the bank balance sheets, the four banks, Macquarie, the regionals, together lend, they have assets on their balance sheet of around $4 trillion. Not all of those are loans, but it makes up the majority of it. I think there's around 500 billion of that 4 trillion, which is going to be contestable, and the banks are going to shed. It's a huge amount of money that needs to be provided when you're talking about providing equity. And so in this early stage, what we're seeing is the opportunity to invest private debt when you don't have a lot of competitors and get overpaid for it. And in a nutshell, that is at the essence of these private debt strategies. We're lending to a low risk part of the capital structure, and we're still getting paid as though we're making a high risk equity investment. And it's really what I would describe as an access trade.
Just a bit further on that, have you seen that changing over the past couple of years? Have you seen newer entrants arriving to take advantage of that opportunity? I mean, how have you seen the competitive landscape for you?
Yeah, I think there's the emergence and growth in the domestic non-bank lenders, such as Mitch's fund and my own. I could probably name 10 others. With sort of the emergence where, but the biggest one is probably still 5-6 billion. We're at a couple of billion. They're not big in the scope of the need. So I think all of those groups are going to have to grow, and they really as we say, to help fund and build Australia, you need credit. It's a pretty basic sort of economic tenet. If you don't have credit growth, you don't have economic growth. And so we need the provision of credit. We did start to see a lot more of the foreign credit funds and banks turning up prior to COVID. COVID has obviously made it very challenging for people to come and do due diligence. It's also forced them back to their home markets with some problems they're dealing with. And so whilst we had started to see some tightening in pricing leading into COVID, we've seen it reverse quite rapidly the other way, that there's just an absence of an ability to deploy. And that really is what one of the elements that characterises the barriers here. When you're writing a private loan, it's a bit like a process of buying a private business. You have to go through, you have to find the opportunity, you have to underwrite it, you have to do extensive credit work. It's not like buying a bond or buying something that's listed. And so the ability to execute on that strategy is probably more challenging sometimes than making the investment decision.
Yeah, thank you. And Mitch, you and I were talking last week about that very point and you mentioned it a bit earlier about the sort of the brain drain from the Australian banks and the emptying of credit decisioning skills from the Australian banks. And certainly, I know in both of your teams, you place a large amount of emphasis on that ability. Can you just talk a little bit about how you've seen that evolve?
Yeah, in terms of the question of do we see banks coming and re-entering this sort of the market that we focus on, I think I have to give a strong no. We don't, and it's due to the de-skilling. We think it might have been going on since as far back as the early 90s, post-recession, when one of the banks in particular had a near-death experience, and they sort of went back to, well, what are we safe on? Well, let's do residential mortgages. And we think that the sort of loss of credit skills, credit analysis skills, perhaps began then. And then as banks have become more and more productized and more efficient, we've seen a continuation of that. Now at very senior levels, they'll admit in a room, but not publicly, that they don't do that sort of lending. And there was a really big, NAB in particular, lost some people with decades and decades of deep credit experience and workout experience a couple of years ago, when there was a wave of redundancies, and that was perhaps the last generation. So we think that if they decided it was a good idea, it'd still be very difficult because you'd have to train people up from scratch, and they've really lost a lot of that knowledge. Again, there's some very, very intelligent credit analysts and people in the institutional part of the bank. I'm talking about in business banking, part of the world. So yeah, we're not expecting them back, and you can see sort of even recently in announcements, we want to get back into business lending, and if you read the detail of what they're offering, it's a algorithm approved 20-minute approval process to borrow up to $50,000 or $100,000. So no, we think our sector is unfashionable enough that the banks don't want to make a return. In terms of other non-bank lenders, we find that we encounter competition at $10 million and above, maybe some very weak or reluctant competition at $5 million and above. But not many folks want to write the average size deals that we do. I mean, the average size of the loan that sits in the direct lending fund is $5.2 million. It's not sexy. And finding people that want to write those loans, again, we get lots of bank applications. We're not interested in those folks because they haven't had any workout experience. If you're a frontline banker and something goes wrong, it goes to the workout department. We'd be interested in talking to the workout departments, but they've been thinned out recently. So we hire almost exclusively from insolvency practitioners. And my own background is in distressed credit and business lending. So that's where we get it from. And it's frankly a limitation on how fast we can grow, is finding the people with the right skill set.
Thanks, Mitch. It's probably a good time to turn to specifics of the strategy. I mean, Adrian, can you talk through the types of investments that you're looking at making, the types of loans that you're looking at making? I've got a couple of case studies here, so let me know if you want me to bring them up. And what's a typical investment for the fund?
Yeah, sure. So maybe you can bring up page 7 of the presentation. Our portfolio at this point in time has around 40% exposure to residential, multi-residential buildings or land estates. Around 25% of the portfolio is in agriculture, approximately 20% in office and office development, and then a plethora of other mixed-use assets, a little infrastructure. We have 5% retail, which I'll talk about because it's a fairly topical area. We actually see it as a growth opportunity. I guess retail and growth, you don't probably hear those two things said in one sentence these days. But I'll step you through some examples, and these are recent loans that we've written. the first few that I'll point out, and then the latter few examples are actually ones at the tail end of their life as a loan, and we'll talk about what we're experiencing and what we're seeing. Because in our business, it's actually easy to give people money. The challenge is getting the money back. That's the job, right? There's plenty of people that want money. There's not that many people that want to give it back to you necessarily. But so Adrian Redlich is a loan that we wrote in the last few weeks. It's an aggregation of farming assets to the Agrinova Group in southern New South Wales, in very highly productive country, and they're recently acquiring some land up near the Ord River. So moving to where they basically see better value and abundant water. This is a loan that was previously with Westpac. We refinanced it. We provided them $41.5 million against an end value of around $80 million for their land and their water rights. And what's not included in that value is all the equipment, machinery, and other assets they have, which takes you well into the $95 million. So when you think about it, just the economic analysis of this investment, we're providing $41.5 million against a sworn valuations and our own due diligence that justifies sort of $90 million of assets. And it's a 12-month loan. Their focus is to sell some of the assets to reduce their leverage, but they wanted to move to grow in the North WA and Northern Territory before they could make those sales. So they were willing to pay 10% plus interest rate for that transitionary capital. And it is important, you'll see a lot of our loans are 1 to 2 years, maybe 3 at a stretch in duration. You can't lend at high rates against a boring asset class like real estate that only yields 4, 5, 6% and earn 10% for a long period of time. So it's usually transitionary or growth capital that we're providing, and in some cases construction funding. So fairly simple analysis. $80-90 million of assets securing a loan of $45 million. The $45 million includes $41.5 million of principal, and then another $4 million of interest and capitalising over that time. So one of the things that differentiates us is our ability to capitalise interest. So we don't necessarily need the borrower to pay the interest along the way, whereas that has become much more challenging in bank land. A lot of the new regulatory rules since 2015, where the banks must receive running interest and good interest cover under a lot of the new rules being introduced in the banking system. So it's a very standard agricultural loan. Interestingly, agriculture is performing extremely well. We're seeing from our underlying borrowers, we see their profit and loss statements regularly. Performance is good. And I think the outlook is extremely good for the next 12 months with good pricing, particularly domestically. There's been obviously a huge surge in, I think, some food pricing. And it's the first time we've seen farmers, particularly in things like vegetables, seeing some pricing power for a long period of time. And certainly COVID induced and sort of restocking. The other element is the good rainfalls throughout the East Coast really removes a lot of that tail risk, which is drought, that can be problematic if you're trying to refinance or sell assets. Maybe moving ahead, Jonathan, to the other end of the spectrum, something that is agriculture, I would say, is quite well embraced at the moment. We're actually seeing lots of transactions by big institutions wanting to buy agriculture. We're seeing lots of individuals buying farmland. Almost that push to leave the city to some degree has sort of been spurred. At the other end of the extreme, retail is an area which is on the nose. You'll see lots of REITs start to sell assets to privates. And so we think it's a really interesting space. This particular asset, which we financed, the Armstrong Creek Town Centre, it's located just between Geelong and Torquay on the Surf Coast down here in Victoria. It is Australia's fastest growing suburb. So the demographics of this suburb are quite incredible in terms of the growth and the need for more supermarkets, butchers, service centres, council offices. And so this town centre, we provided funding at the completion of the first wave of construction, which is the new supermarket and a whole range of other services. This loan is against valuation. It's a 40% loan to value. So really low in our spectrum. It's really truly been bank land. I think one of the challenges is the banks are very reluctant to go into new retail exposures at this point in time. They've got lots of problems on their books with some of the more discretionary part of retail. And so we see the funding of consumer staple retail as a real opportunity because it's caught up in the mix. So again, we're earning circa 10% at a very low LVR. And so I think one of the challenges here is it's a new centre, so it's in ramp up mode. The cash flow from the Coles, for instance, is in its infancy. It just opened in July. And there's still a wave of construction to happen on the site with the new McDonald's, service stations, potentially a Bunnings. That's not yet a done deal, but potentially certainly a Dan Murphy and other what I describe as consumer staples. So not a exciting investment in terms of it's very boring, low key. It's really the ability to have a team to go and find those loans, to run through. There was quite a lot of complexity in taking the mortgage here. And so that was the challenge, a very extensive legal process to get there. And I think that's where most fund managers and most investors can't participate. And full credit to Koda. I think most of Koda's competitors, they only want to invest in things which can fit nicely on a platform and it's easy to manage in the back end. I think the future here in Australia, as the world gets a bit harder, it's going and hunting and finding those things which are a bit different. And maybe the investment risk is actually low, but the real opportunity is actually in the execution here. And I think, when you look at Koda, they have a whole portfolio of these, and both Mitch and I make up part of that context. Maybe if we move ahead, Jonathan, just to a couple other slides here. Park House, this has probably been the domain of the non-bank sector in regards to property for the last 5 years, and it was where we saw the first wave of capital being required. This is a 500 apartment development in Johnson Street in Melbourne, or just on the outskirts of Melbourne, Abbotsford. Has extremely good sponsors in Salter Group and the Smorgon family. So very good borrowers. The thing that was differentiating about this loan at the time that made it non-bankable was it had about 40% of the apartment sales were with Chinese. And so I've intentionally added this because I know it's a question that often gets asked, is now that apartment building is being delivered and Tower A of this building is just complete, and we're seeing a wave of settlements come in, people are asking, but are people settling? Is there a problem? Were these apartment prices too high? And I think what we're seeing generally throughout our portfolio is we're not seeing settlement risk out of Chinese purchasers. We're not seeing settlement risk out of local buyers. It is just taking a lot longer for the individual buyers to get their mortgage processed through the bank. The bank is just requiring such a high hurdle that's been introduced around documentation, multi-point checks to see, checking people's credit cards, their income serviceability. And so the banks have really had the blowtorch put on them post the Royal Commission that it's forcing them to be quite slow. And so I think the issue is the provision of credit is really slow. But when we look at the aggregate numbers across the economy, the one place that credit growth has been really good, and even during COVID, is actually been the provision of mortgages to owner-occupier in general. And then, there's some of the loans that we're seeing. I can talk about loan enforcement, or I can come back to that in the context, I think, Jonathan, when we talk about COVID.
I might come back to that. Thanks, Adrian. Mitch, can you talk through something similar? So I suppose, how many loans inside your portfolio? What's the average size? Can you describe some of the businesses that you're attracted to lending to? And a couple of questions along the way that people have been asking. The frequency of your team, doing due diligence, meeting with borrowers, the degree of contact as well. I know that's a huge part of both of your approaches. But could you perhaps give us the helicopter view of the portfolio, some typical examples, and then and sort of end on that contact?
Yeah, no problem. As I mentioned, the average size of the loan exposure in the Longreach Direct Lending Fund, which is the Koda vehicle, is $5.2 million. Total, that's 30 borrowers. Our total portfolio across two funds, because we have a separate fund with the mirror mandate with a single institutional investor, is $225 million today. So that's all been put on since April 2018. One of the things that I think both Adrian and I enjoy about our offering is the level of information that we have access to. In that, it's everything. If you don't get everything, then you stop dealing with that borrower. And for us, it's earnings season every month. So on the 30 days after month end, we get a full set of management accounts, plus some other information from each and every borrower in our portfolio. And then in terms of how frequently we speak with borrowers, it's some of them, some of the really low maintenance ones, it might only be once every couple of months because there's literally nothing to talk about. Each of them, we do a full annual review where we go back to investment committee and we do a review and assess, and confirm that the loan should be continue to be marked at par. But we write a full credit paper again every 12 months. And every month we get that reporting from all of our borrowers, which is just vital, right? Because if we've had early warnings on things in the past, acted on it early. And it's had very good results for our investors. I can talk through 30 examples, but there's one of them that's topical today because it's come out into the public domain, and quite often we don't release sort of names of borrowers, but this company has released its prospectus and is expected to IPO in October, and it's a pretty good example of the loan opportunities that we see. So the business is Aussie Broadband. It's an internet service provider. I think number 5 in the country by market share, but to be clear, it goes sort of Telstra and then falls off very, very heavily. So Aussie Broadband has about a 3 or a 4% market share. We were introduced to them late calendar 2018 by an advisor that I've known for many, many years. And it was fascinating because this is a company who'd been in existence for a long time, was growing significantly. So the year ended June 2018. I think they had $50 million of revenue, and they would go on to do 100 for the next year. So they were at a rate of doubling their revenue. They had no debt. They went to their existing Big Four bank and said, "We've got a once in a technology lifespan opportunity to increase our market share and grow the value of our business by advertising more while the NBN is being rolled out." We've all gone through that process of NBNs coming to your suburb and you have to decide, are you going to stay with Telstra or are you going to change? And they were doubling their market share in every suburb that happened, and they wanted to spend an extra $5 million, because this was an opportunity that wasn't going to be repeated. And so they went to their existing bank, and who could see, they run the direct debits, tens of millions of dollars running through that account for years and years. That went up to head office. Head office said, "Sorry, we are overweight on the sector, being on telecommunications or internet service providers." I don't know, but it was just a flat no. Another bank looked at it but said, "Oh, it's a bit harder, for a small loan." And then, to their dismay, they were then speaking to us about an interest rate of 12% per annum for a senior loan. So, and when we looked at it, and they were profitable. They were spending, the more money they spent on marketing, the less profitable they were, but the more they were adding to their enterprise value. And it was clearly a great investment for them to make. But we looked at it and we did the maths. We said, well, what's the liquidation value of an internet subscriber? And that's what they call us. And you can do a certain number of $100 per head, even in a liquidation value. And on that basis, we thought we were 3, 4, 5 times covered on a $5.5 million loan. We wrote the loan in late 2018 at a 12% interest rate, senior secured. So the company is going to list at a $150 million enterprise value. next month. Our loan, whether they repay it now or repay it at maturity in February next year, we're unsure. And the business, has, I think $20 million cash on the balance sheet today. It's an outsized return, but it's indicative of the sort of opportunities. We have to go and hunt round for them, and there's, we don't have hundreds, right? We've got 30 loans. But you find these companies that just are in that awkward stage where a bank, it's not worth the bank's while to write a small loan, and it allows you to generate an outsized return. Now, it's in our interests. Like Adrian, the longest sort of date maturity that we write is 3 years. The average tenor of the book at any point in time sort of moves between 18 months and 24 months. And we would like to start having longer relationships with these borrowers, particularly when they graduate. Next year the company's put out in their forecast a $13 million EBITDA for FY21. And we'd like to offer them, an alternative that isn't a 12% loan. And so we want to graduate borrowers who would otherwise leave us or repay. And that's where we have set up a new strategy that will particularly house those lower interest rates sort of graduate loans rather than lose them forever, because they're our favourite borrowers, the ones that we've known for a couple of years. But it's only one example, but a really topical one, and one that's out in the public domain, and we're really proud to talk about. And I was speaking with the CEO yesterday, and I said, look, we want to do everything we can to stay in your capital structure. And he said, Mitch, you did everything right by us. You did what you said you'd do. And sometimes folks sort of wonder, and they say, oh my God, a 12% interest rate, doesn't it cause angst or conflict or friction between borrower and lender? And it's not the case. Like, it's not, of these borrowers, 90% of them came to us to borrow for growth, and they see the increase in their enterprise value if only they had that capital. Aussie Broadband was the same. They could see that their business was going to probably double in value next year anyway, but maybe it might quadruple if they could just have this $5 million to spend on marketing. So they're the companies that come to us and they don't begrudge us, an interest rate like 10, 11, 12, 13%, because they're saying that's peanuts compared to the enterprise value that we're building here. And that's quite often the conversation we have during the negotiation phase. Thanks,
Mitch. I think we'll get into some of these sectors that you, I suppose, like and have lent money to, and some that you haven't. You've prepared some sort of analysis for us. But I think it's probably a good time to start talking about COVID-19 and start talking about the enhanced risk environment that we're in. So I'm interested in sort of how both of your experience has been over the past 7 or 8 months, and what you see the outlook looking like before we then move into sort of some other questions that are coming through now. But Adrian, I might go to you first. How have you found the COVID-19 period? What adjustments have you made? Are you seeing any increased risks, and and what are you doing to mitigate that?
Thanks, Jonathan. I think like many fundamental investors, I guess we've all been surprised by the strength of markets, the strength of asset values, and it's been something that's a nice surprise. And our overarching macro lens is probably one that can be best described that we think the investment world is going to maintain confidence in central banks' ability to print unimaginable, unprecedented amounts of money that don't make sense to me. But I think the investment world will maintain confidence in it. So it doesn't have to make sense to me as an investor. What do you think it's going to mean to everyone else? How are they going to behave? And I think we by context, if you look at April alone, the Federal Reserve basically bought, or printed money, as some people would describe it, $1.2 trillion of assets. In contrast, it took them 2 years to do that post the end of the GFC. So the speed and velocity of response has been startling. And so our approach to that has been, we think asset prices will be well supported, despite what we think is going to be potentially some economically weak cash flows at times and in sectors. And we think a lot of it's confidence driven. It's kind of a Keynesian experiment, that comes out of the Great Depression and has been taken to an extreme example. And so, yeah, that's sort of our view. We're going to see problems. They're going to come to the fore. We have enforced on one loan, and Mitch and I were talking about this before offline, comparing notes, and we've been comparing notes with receivers. You would think that receivers and administrators are basically in their golden era. The truth is, the last 6 months has seen the lowest level of receivership and bankruptcy in Australian history. And it's for a range of reasons, but largely driven by what's called a safe harbour rule, which basically means companies can trade insolvent. They don't need to sort of hand the keys back. And also different government programs, whether it be JobKeeper and the like. Many companies and the underlying has been quite good. So our approach to this, with this in mind, when we saw the level of stimulus, I guess we've all been trained in the financial market. They're a bit like Pavlov's dog. The Federal Reserve rings the bell and says, "Here's the money," and we've all been trained to think that's going to support asset prices. Our way of dealing with that is to go to, over the last few years, to go to a less risky asset class, to reduce our leverage ratios, but keep actively lending because we're seeing the dislocation. And so that's sort of the overarching, our macro overview. The second thing is to enforce quickly. The advantage that private debt has over the banks is the banks are too scared to tip someone up. They're too scared to enforce. They're too scared to protect their position because of the fallout of the Royal Commission. They're too scared that if they sell one property and have to write the value down, what does it mean for the rest of their book? And there's just general pressure on the banks. So banks' ability to work through a problem is more challenged. And to Mitch's point, we have 40 loans in our portfolio. They're high margin. They pay high fees. We've got a lot of people allocated to each loan. It's just different in terms of the ability to work through it. So we have foreclosed on one loan, and we were gobsmacked by the amount of bids for that asset in the middle of COVID. We took an asset to market. It was a small asset. It was a classic apartment development site in a fairly affluent area of Melbourne, and we took it to market, and there were 17 expressions of interest, and people were jumping over themselves because they felt it was a distressed opportunity, and there's so much cash out there and so many people looking for that distress, they jumped on it. And it's ended up being one of our better loans, because the dirty secret of credit funds is that, of course, when your borrower goes into default, you charge quite a high interest rate. And so this loan, instead of earning 12.7, which was the projected earnings over the life of the loan, they ended up earning 14%, because for the last few months of the loan, we earned an incremental 5% penalty interest. So it was a good experience. But as they say, past performance, not really a predictor of the future. And Australia's, you'd have to think is going to be challenging. And so when you're earning 10, 11% and you're seeing great opportunities, you're basically earning equity-like returns. So we think we're going to see the odd issue, but generally we're not seeing them yet in any big wave or form. So, but what I would say for sure is, where our business was focused more on residential apartment developments, that's where the vacuum was. The vacuum now is economy-wide. And so the opportunity set is bigger, and we think that asset prices will be artificially buoyed, but we're going to protect ourselves to the downside by taking the most conservative piece of the capital stack.
And while I've got you, Adrian, your firm Merricks has a history and heritage in agriculture and commodity investment. You mentioned you're seeing lots of opportunities in that space, but it's a peculiar skill set, and not everyone possesses it. So are you seeing that as an area of growth for loans moving forward?
Yeah, no, unequivocally, and we've expanded our team. We recently took on a team of 3 who'd come out of FTI and McGrath Nichols, so specialising in agriculture. So not only the ability to find loans, but to restructure and deal with difficult times. And we see that as a big opportunity. Agriculture is one of those areas where there is a big demand from big institutional investors, particularly offshore sovereign funds and others that want to buy big slabs of Australia and New Zealand. But we have almost no competition in terms of debt provision. There are people that want to write a $40 million loan for agriculture, but we don't have much competition. And when you don't have a lot of competition, you tend to over-earn for a while. And so we think it's a space that we have an advantage, we'll over-earn. And like all good things, at some point the return profile and the interest rates we can charge will compress. But we think earning 10% return on an asset where banks have been earning 4%, there's a long way to go between that compression of what's fair value in this space. And I think that is true of private debt in general. I think we're in the early stages here, and we think the forward look is the economy is going to need a lot more private credit, and to attract money out of super funds and out of the listed equity market and listed fixed income is going to have to pay a higher rate to get it to move from one bucket to the other. I think Koda is just an early adopter.
Thank you, Adrian. Mitch, do you want to talk about COVID-19, how you've seen the period, where you're seeing opportunities, and probably a good opportunity to talk sort of sector by sector at, the types of companies that you're finding more appealing to lend to?
Yeah, and look, in terms of our approach, it hasn't changed. Like when we were writing loans in 2018 and 19, it was on the assumption that there was going to be a long overdue recession. We've got by design a couple of old grumpy heads on our investment committee, and we're all credit folk, so the glass is always half empty. So any loan we wrote was an assumption of more of a traditional recession. None of us saw a global pandemic coming. So that kept us away from bricks and mortar retail. As you know, we don't have any direct exposure to commodities, nor to property. So we're always just entirely focused on cash flow. Like how regular is the cash flow? The first loan we put in the fund, and is still there today, is a recycling company that has most of the councils north of the Harbour Bridge, and very, very boring. And that's our sort of borrower. And we look at it, we try and think of, what could go wrong there, and we really think about this very, very specific risks for very specific companies. And I think that's become even more important in this environment. So in the slide that's on the screen at the moment, there's been a lot of unexpected outcomes of COVID. And this mirrors sort of what we've seen a little bit, which is that broadly, our borrowers are reporting record profits. In May, June, July, they've never been more profitable. Almost all of them, probably 80% of them, in March, in the middle of March, when no one knew what was going on and everyone was kind of panicking, they all attacked their operating expenditure line. They cut employee costs, and they cut them quickly. And they got rid of their bottom 10% of performers. Some of them put their staff on a 4-day work week just because we don't know what this is. And it's really funny, because if you would have asked them all in January, does your business have any fat on it, anything that you can cut? They would have said, no, we run lean, there's nothing to cut here. But when the chips were down, we found that there was plenty of those, plenty of expense line to cut. And that's the real importance of having a good management team. And that's why we spend a lot of time with management teams before we lend. We don't just look at the financials and say, oh, that looks good. You got to know you've got a good management team. So we saw OPEX come out. Now you can see that in this graph. It's only a slight bend down, but it's really unusual for the ABS to show that wages expenditure by companies, so this is for all companies in the economy, dropped by 2.5% in the quarter. So not inconsistent with what we saw. So we've seen profits up across our portfolio. Most have had revenue lines unaffected. Some are up. A couple are down. The one that was most pronounced down was we lent to the franchisor group of a fast food chain that has 200 sites across the country, and that was kind of the proxy really for general normal everyday economic activity. And seeing their revenue fell as low as 30%, 30, and the very bottom point of that, and they get daily information. The very bottom point was Easter weekend, right in the middle of April. And then we saw it's sort of steadied, and it built and it built and it built and it built, and sitting at about 105% of pre-COVID levels today. So it's more than fully recovered. And that's selling $10 and $15 meals, right? And it's an interesting proxy for just general everyday activity out of there. What's interesting in this graph, though, is the dotted line at the bottom, which is how much tax, not company tax, but things like GST companies pay. You see it went largely negative in June, which represents JobKeeper and other sorts of cash. If you strip out that cash, then what we call adjusted or underlying cash profit, we think economy-wide was down 7.5% for the quarter. So that's economy-wide. That's kind of interesting. But for us, specifics matter. So Jonathan, can we go to the next slide? This is our measure of the underlying profitability of each industry, according to the ABS or the Bureau of Statistics sort of breakdown. The red ones at the bottom being the ones that are particularly hurt. And it's no surprise. But so, let's not sort of dwell there, because we get enough of that from the press, talking about how, physios are down, hair and beauty, travel agents, hotels, universities. It's what you would expect. The top half of this is interesting, right? Wholesale, folks up 7, 6, 4, 3, 2, or flat percentage for the quarter is a big part of the economy. And just for perspective, again, thinking we only have 30 positions, we can see that growing to 50, 60, maybe one day 100. It's a tiny, tiny, tiny proportion of the total economy, and it does allow us to sit here and pick these industries that are performing, fine through this or are unaffected. They happen to be the same ones that existed before. And Jonathan, can we just go to the last one? Oh, sorry, the next slide. This is fascinating. This is looking purely at retail trade, and so if you can see that graph on the right hand side. It's seasonally adjusted. It shouldn't whipsaw around like this. Like it arguably never has. We've only gone back 10 years in this graph. But this shows the volatility is so much value moving about and from one to the other, and folks are up and down. The specifics matter. If you're selling booze, you're up 34% year on year, your March to July this year versus last year. Bunnings is up, hardware, supermarkets, and then the guys that are down are really, really down. So cafes and restaurants are down at the bottom, clothing retailing down 22%. Now we can get more granular, but I could do an infinite number of slides. Clothing retailing is really interesting because it looks here like it's down 22%. If you go to a state level in New South Wales, it's almost recovered to its normal seasonal level. It's down about between 5 and 10% today. In Victoria, it started to recover and fell again. The specifics matter. So we're never going to change, but I think it's probably made it more important that we're very, very, very specific in our analysis of each and every borrower and understand the risks, for that particular borrower. We're not going to do anything sort of industry-wide or economy-wide or say, hey, this product works. It's more of the same of old-fashioned sort of high-calorie credit analysis.
Great, thank you. I think that covers off on the COVID-19 period fairly well. We're bumping up against time. I've just got a couple of questions from the participants that I might just work through. Adrian, a couple for you. Just a question around sort of insurance, portfolio insurance. How do you think about the portfolio? Can you take any form of insurance on the portfolio outside of your traditional risk management measures? I mean, what's your view there?
Yeah, so I think those who know us well within the Koda family know that we do something that's probably different to other hard asset lenders, that we've taken the opportunity to buy what's known as credit default swaps on banks, on other big property companies, and sort of a general macro hedge. The pricing of that insurance at the moment is the cheapest it's been since prior to the financial crisis in 2007. It's crazy, to be blunt. I mean, for us to be able to spend 40 basis points a year, so 0.4%, and to hedge our portfolio against a big macro meltdown, it's a gift, really. So we'll grab it with both hands. We thank the government, because the government's basically funding bank balance sheets in many different ways. and we'll happily go on our way and lend directly where we're earning 10% and hedge the portfolio at 0.4. Now, it's not a perfect hedge. We know that. It's not designed to be. What it's designed to do is that when the world really has a difficult time, we get a payoff, that any problems that we have are counterbalanced. And so what we found in March, for instance, the COVID sell-off was pretty quick, really. I mean, as we all know, too quick in some ways, not enough opportunity time to take advantage of the opportunity. But what we found is that because of this insurance, our portfolio on a day-to-day basis has sort of almost become inversely correlated with the stock market. And so we had one of our best months ever in March because the insurance went up. And then in April, we actually had our worst month ever because the insurance reversed in value. And it was the only negative month we'd ever had, but it wasn't the underlying loans, it was just the value of insurance. So look, it creates it's not the best marketing ploy in terms of providing monthly P&L. People shy away when they see, oh, that was a big up and a big down. But the reality is when people realise how little we're paying for it and the chance of loss is so, there's no chance of loss, it's just protection, but it does create a bit of noise. But I think if you can find these little ways of hedging yourself and risk management that preserve the tail risk, and whether that be low leverage, good businesses, or insurance, that's our job. That's what you pay your manager to do. As I said at the beginning, putting the money out, that's easy. Getting it back, that's our job.
Thanks. And while I've got you, a question for both of you, but I'll start with you, Adrian. Do you prefer to be the sole lender, or do you involve yourself in syndicates with other investors and lenders? And what's your view and experience?
We're somewhat agnostic. Our job is to be a portfolio manager, an investor, to get as best diversified portfolio as we can. So our focus is on clearly risk management, making sure we've got control of the loan, but to be diversified. So I think one of the things that differentiates us between some of the houses that has emerged as sort of from investment bankers, we're not trying to hang on to the investment banking fee. We're trying to get a broad portfolio, and sometimes the best way to do that is to partner. Mitch and I before were just, we were talking about a loan that maybe we could share, we could look at. And so I think sometimes you get lots of smart people around something, you get a better outcome as well. So sometimes it's better to partner. The number one thing for us is making sure that if we do partner, that the control rights and things we have is not going to inhibit us from protecting the assets. That's number one rule, but partnering is often a good thing.
Yeah.
Great, thank you. And Mitch, what's your view?
Yeah, look, we generally don't because again, we're writing smaller loans and we want to be able to control our execution. One of the things that's got us a good reputation in this market and gets us referrals to other borrowers is coming through with an approval, on the date that we said we were going to, and we don't want to be subject to someone else's investment committee process if it's not as tightly run as our own. Having said that, if someone brings genuine value by co-lending with us, then we will bring them in. We do have a live example of that at the moment where the old lender has been repaid in full recently, and they have made it known to us, sort of around the side door, that even though we won the next loan, they'd like to participate in that. If the old lender wants to participate in the new loan, then that's some value because they've got some more knowledge of how that borrower behaves, and it's such a valid or such a wonderful point of validation that they're not going, oh, thank goodness I'm done with that loan, I'm out, I never have to deal with them again. So in that case, we'll explore it, but that would be the only one so far.
Great. And look, one final question, and then I think we'll start to wrap up. But got a question here from a client about where you're sourcing your loans and opportunities, and have you seen that change?
Yeah. Look, mine, ours is a little bit of a random walk. The very first loan, in the portfolio, the one to the recycling company, I had funded a sister company, for a number of years when I was at Macquarie. So I had a pre-existing relationship with the CFO, and it was a treat really to be able to lend to someone that I already knew. But then it's pretty old-fashioned. I was going to say, well, you get on a plane, but we don't do that lately. But go to Brisbane, go to Melbourne, and introduce yourself to financial advisors, of which there's many more than anyone can guess. introduce yourself, talk about what you do. But then we're in a space now where, you know, we were at a standing start early in 2018. The word of mouth effect is very, very powerful. Particularly when you've got good execution. If you take people along on a journey for months and say, yeah, I can, yeah, I can, yeah, I can, and then you routinely say, oh, sorry, I don't want to anymore, you know, you get a bad reputation quite easily in this market. And so we've made sure not to lead people along if we're not going to write the loan. And that kind of looks after itself to a degree. Having said that, we're just about to hit smaller accounting firms in a pretty concerted manner over the rest of the year. Not the big four or even second tier, but looking for smaller accounting firms for those uncompetitive situations where, you know, we genuinely have no competition.
Great. And Adrian, where do the source of most of your opportunities come from, and has that changed?
Yeah, so we have a team internally that manages sort of that channel of where loans come from. But we have some exclusive relationships with a raft of different groups, from Australian Unity to some of the big building companies. And then we have also gone out of our way to support a lot of people that have exited the banks. As Mitch described earlier, there's just an ongoing exodus from the banks. And so there's a lot of people who have set up consulting businesses that have a lot of IP and relationships with borrowers for a long period of time. And we've gone out of our way. We've set up programs to actually help them fund their business, to support them. But one of the things we don't want to do is to build a big sort of mortgage broking type business internally, because one of the things we're all going to have to do is, as a group credit manager, is sometimes you're going to have to turn off the tap. And so one of the things we try to make clear to everyone, and it's even basically, we make it clear in our sort of marketing material, our focus is solely to represent the investor client. We don't sort of talk about borrowers as our client even. Sometimes it pisses them off, to be honest, pardon my language, but that's a big, so we have a wide channel. And so what we like to do is have someone else that's in the mix that purports to be, where the borrower is their client. It's generally not us.
Thank you, Adrian. Gentlemen, we're going to start to draw to a close, but before I thank you and say goodbye, for all participants on the line, when you end the webinar, a short survey will just pop up. We're really interested to see how you found today's webinar, and if you have any further questions. From the number of people that have hung on for the entire time, I can see here it's been a very compelling and very interesting session. So can I say thank you, Mitch, to you, and thank you, Adrian, for your time and your generosity with your thoughts and insight. And I'll draw the webinar to a close. So thank you very much, and goodbye.
Sure.